Let's bring you more analysis now and bring in Chief Economist at Betashares, David Bassanese. Good to see you. Thank you so much, David, for your time. What sort of justification are you expecting we'll see and hear from Michelle Bullock shortly when she does hold her highly anticipated news conference?
Yeah, hi, great to be with you. Look, my sense is, they're obviously still concerned with inflation. I mean, the numbers last week were a bit lower than what the market expected, but still not that great. They weren't bad enough, I think, to justify a rate rise. But the RBA, certainly looking at the sort of rhetoric from the statement today, is still concerned with inflation. There's still a mild tightening bias out there, if anything, in the short run. You know, obviously subject to share market volatility, subject to concerns about a US recession, which is new news just in the past few days. But at the moment, you know, inflation is still seen as too high and coming down only gradually. So at best, I think at the moment they've got, you know, rates on hold. But if share market volatility dies down and concerns about the US economy go away, we may, you know, still be left with a tightening bias here and hoping that inflation can come down.
Well, that was my next question. What is your sense in terms of where things go to from here for people sitting at home watching who are looking at their mortgage and wondering how things are going to pan out there? When do you expect we'll see the next move?
You look, my base case is that we will get a rate cut and we will get one by year end, November, most likely December, but certainly by, I think, early next year around, say, the February meeting. In February, we will have got the December quarter CPI. And if trim mean inflation, which is currently just under 4, is down around 3.5, I think the new forecasts are for it to be 3.5%. At the end of the year, which is a touch higher than what they were forecasting back in May. I think that would be sufficient for them to start to remove some of the policy restrictiveness. It doesn't need to get all the way back to the target band before they can start to do that. And certainly aided by likely at least 2, possibly 3 rate cuts from the US Federal Reserve by that stage.
As you alluded to, this rate's decision comes while in the background we're seeing some pretty serious volatility on the global markets. What's your analysis of what we're actually seeing unfolding there?
Yeah, I think there's 2 key drivers here. Firstly, there's the concern about the US recession on the back of the weak employment numbers on Friday, but also just that coinciding with the Bank of Japan's increase in interest rates and the strength of the yen. And I think it's really the so-called unwinding of the yen carry trade. You know, the strength of the yen has led many investors to have to bail out of their short position or the borrowing of yen to buy assets. And it's been that sell down, that rapid sell down of assets as that trade has unwound, that I think has been the major driver. Now, if that's the case, this sort of short run volatility, I think, will be temporary. And markets should stabilise. I do think the US economy is in pretty good shape despite that weak employment report on Friday. So I don't anticipate a recession anytime soon. So I do think this is just a short-run correction rather than the start of an extended bear market.
Well, plenty of investors will be hoping you're right, David, on that one. David Bassanese, really appreciate you joining us with your analysis on that breaking news.